Thomas, we're back, my friend.
All right, that was
Tasty
funny.
bites.
Let's do it. By the way, S&Ps are down $5, and
Trading 1626.
yeah, the Dow is really weak this morning. Funny because the Russell's only down $2 and the Dow's down 50. I can't believe how much that trade widened out.
That's right.
But anyway, listen, it is what it is, and we move on. Let's do this Tasty Bite segment. It's really well put together today. The reason we take breaks, because somebody asked me, why do we even need to take breaks? Because, I've watched your commercials. They're funny, but, we have to for our archives. So we have so many different cameras. Everything here is remote, all over the place. That this way we make sure that all our archives are accurate and we can
So that
space
you can
everything out.
watch it. You don't have
That's
to
right.
go through the whole show. When you go through the archives, you can just stop at each one.
Yeah, and then Tony and I, sometimes we have to yell at each other for about 30 seconds, and then we're fine. Then we give one of these, and we're good. And sometimes Vanetta just has to,
Vent a little herself.
yeah, she gives it to me and Tony, and then we're...
She usually just gives it to you.
Yeah, usually me. And so that's it. But we keep them short. Anyway, trading verticals. You ready? Tasty Bites. This is for accounts that are, we like to say, under the PDT, pattern day trading, which is $25,000. So anything less than $25,000, this is kind of what we're geared towards, where you have these, which I think are rules that need to be changed as well, which pattern day trading rules, because really the concept of day trading doesn't exist anymore. But let's focus on verticals for a second, and we did something a little bit different. Trading verticals. In smaller sized accounts, we often recommend avoiding higher risk trades, such as selling naked puts, selling naked of puts and calls. Now, to be completely fair, we don't want you to avoid it. We want you to avoid it as the sole source of revenue. In other words, we think it's important that you're both strategically diversified and you are underlying diversified. Okay, so you're product diversified, and product could mean anything. Could mean an underlying, could mean really, literally a different product. But we don't want you to get, what happens sometimes is you fall in love. As soon as you taste chocolate, you want chocolate. Okay,
The forbidden fruit.
as soon as you taste something that's really good, that's all you want, and you don't want to eat anything else. You don't want to have anything else. And what you have to do to be successful, you've got to not necessarily avoid all higher risk trades, but you have to avoid being all in one bucket. We also encourage you to keep we also encourage keeping the variety of strategies to a minimum, and that's understandable. So you have to find that happy place between the number of strategies, the products you're using, and to mix it up. So we decided today we'll talk verticals. Let's go next slide. Today, we're going to look at defined risk strategy that is an effective way to make a directional play in the market. Because the risk is defined, it is essentially beneficial in smaller accounts because it's like a stock replacement, Tony. If I can show you a way, instead of having to put up $1,000, that you could put up $100, or instead of having to put up $2,000, you can put up, $130, then all of a sudden, if you can create a stock replacement mentality, you can learn how to tweak that to become more effective with less money. It is
Isn't that what it's all about?
Yes.
Even if you have a large account, I know this is for small accounts, but even if you have a large account, that's what it's all about.
Sure.
Okay.
Let's just say you're interested in implied volatility, and let's say you want to buy 100 shares of VXX. Well, 100 shares of VXX is $2,000, and if you have a small account, assuming that it's even a margin account, you put up either $2,000 or you fully margin it at $1,000, and that's available to every listener.
Sure.
But even $1,000 is a lot of capital put up to do 100 shares of stock. The alternative is you can buy some kind of delta equivalent. Let's call it 3-4 call spreads, whatever it is, that are $1 wide, 5 call spreads. You may pay $50 each, so you may put up $250. Which is 1/4 of the amount of money to have the same kind of delta effect, and without any additional premium. Now, there are negatives to the debit spreads. The negative being that you don't profit on it on a tick for tick basis. But the positive side to it is you also have limited risk.
Of course.
So there's always trade-offs in this business. Let's go to the.
There's no free ride.
There's always trade-offs. Vertical spreads consist of the purchase of one option and the sale of another option. Both options are the same type, either both puts or both calls. And they both expire at the same time. They only differ in strike price. Next slide. Regardless of whether vertical spread contains puts or calls, whenever a trader buys a lower exercise price and sells the higher price, the position is bullish. The position becomes bearish if the opposite is done. Okay. These are interesting strategies for smaller accounts because even with a large market move, the delta of a position will not invert. A bullish play remains bullish and a bearish play remains bearish. And again, that's the takeaway of having, that is one of the key takeaways of having kind of this vertical spread mentality. Let's leave it on this slide for 1 second. The users of vertical spreads, which is Tony, myself, and everybody out there, it takes a long time to get comfortable on basically how to use vertical spreads and when to use vertical spreads. I didn't get comfortable for a long time in my trading career and a long time when I became a retail trader with vertical spreads, because the first thing I thought is, this is stupid. Okay, I'm wasting a lot of transaction costs. It's hard for me to make, 20, 25 cents, blah, blah, blah. I went through all this stuff in my head. And I'm like, it doesn't make any sense as a retail. I couldn't get to a big enough size where it made enough sense for me. Because between the transaction costs, between everything else, it just I wasn't clear. So you do things like you widen out the strikes. You pick
Talked
and
about
choose.
this yesterday on a phone call.
You widen out the strikes. You pick and choose when you ultimately want to get involved, because sometimes you have positive theta decay and sometimes you have negative theta decay. Once I started to recognize that every time I put on a vertical spread, I essentially want to have positive decay working for me. So I'm buying them at parity or under parity. And when I started to look at it as a stock replacement, widen out the strikes, sometimes ratio it, sometimes not, I started to think, you know what? I really enjoy doing vertical spreads because the duration that they enable me to have, and the combination of duration, measured risk, and high probability of success if I can control it, and the capital reduction started to get me very excited about actively trading again.
Becomes attractive, right?
So it's also a decent low vol strategy. So you know what? To say after all these years, we would say that vertical spreads, to this day, debit or credit spreads, some form of a vertical, still makes up the largest percentage of option trades that we do.
Makes sense.
Okay.
Because
let's go to
it's
the
so
next slide.
advantageous. Yes.
When we trade verticals, we're generally sellers of premium. We look to take in a credit that reflects at least 1/3 the width of the spread. Now, I'm going to be fair about this. It depends on market conditions. If implied volatility is very rich, we look to do credit spreads. If implied volatility we believe is cheap, or we feel like we are directionally inclined, we will lead on the debit spread. A credit spread, higher probability of success. A debit spread, a lower probability of success, still wrapped around 50-50, but a higher payout. And so depending on whether we're directionally inclined and whether we're we're capital challenged. So one of the things about Tasty Bites is vertical spreads, you have a lot of limitations. And when you're going to pick and choose what options you want to be naked short in a Tasty Bite size account, if you're even able to sell like puts and calls, whatever it is, you have to be very careful to pick your spots. Low price stocks, high volatility, low basis, stocks that are in play, tons of liquidity and tons of efficiency. If you decide you want to step outside that box, you don't want to use your capital in a small account to trade a vertical spread. I'm sorry, you don't want to use your capital in a small account to trade a naked option when you can use a vertical spread. There's no way you have enough capital in a small account to trade anything naked or directional in, for example, Apple, Amazon, Google, whatever it is. But a vertical spread's the same whether it's a $500 stock or a $20 stock. Who cares?
Exactly.
Let's go to the next
It
slide.
levels out the playing field between all stocks. It allows you to be able to trade, like you were just saying, a stock that's $400, $500, $800, the same way you can trade a stock that's $5, $6, or $10.
So we decided to go very, very basic, almost beginner-like for this Tasty Bites today, because again, a lot of new listeners and just people that let's get this concept down. So, for example, if we're looking to put on a bullish 1-point wide put spread, we'd look to collect at a minimum 33 cents. Now you'll see we don't do a lot of trades where we're collecting 33 cents. We'll do a lot more trades where we're collecting 67 cents, or we'll do a lot more trades where we're collecting $1.75. We'll use the 1/3 the width of the strikes, but we'll widen out the strikes so that we have an opportunity to trade things that where it's transactionally makes sense. What's the last trade we put on in IBM the other day. We took it off yesterday.
$1.70 something.
$1.74, took it off for a buck.
$1.
That's a great trade. That's a vertical spread. Okay, that's what that is. I mean, we
It was
do
a
this.
$5 wide vertical.
$5 wide vertical spread. But you'll see us all the time. We traded vertical spreads, a couple times last week. It's just a big part of our trading methodology. It doesn't have to be 33 cents on a dollar wide. It could be 167 to 175 on a $5 wide.
Correct. Same proportions.
And they move.
Yes.
All right, let's go to the next slide. Vertical spreads are just one of the many option strategies available. With defined risk, with the defined risk characteristic, they're an essential basic strategy useful in small accounts. And again, we decided to do this very basic today. Just go back to kind of the beginning because people forget. Is that the last one?
That's the last one.
Okay. People forget that how important vertical spreads are as a stock replacement strategy. And again, and nobody talks about this throughout. Like people will say you should be invested. This is one of the things I've never understood about this business. You should be invested. You should be invested in Apple. Okay, Goldman Sachs said the other day, you should buy Apple going into the WWDC conference. So you should buy calls in Apple. Like that's dumb advice. That's not even advice, actually. That's just like saying...
Doesn't matter whether it goes up, down, or sideways. Yeah. It's just dumb advice.
It's just dumb advice on every level because of the premium erosion, because of the low probability of success, everything else. But what they didn't say is, hey, you know what? Buy an at-the-money vertical spread in Apple. You don't have to put up very much money. In fact, right now you can buy an at-the-money vertical spread wherever Apple is for $2.50. Here, the way option pricing is, this is what we call efficient market theory. And the way option pricing is done, no matter where Apple is, one strike in the money and one strike out of the money, no matter where the stock is between $2.40 and $2.60, period.
Correct. And that's in any stock, not
in
just
any
Apple.
stock, it's 50% of the width of the strikes. You go one strike in the money, you go one strike out of the money, you pay 50%. You're controlling, a smaller amount of stock, you have defined risk, and you're participating. Does somebody really need to buy 10 shares of Apple? Does somebody really need to buy 2 shares of Apple? Hey, I read here that this
what would you rather do, buy 2 shares of Apple or do something like this?
That's right. So let's for the first time, let's treat people with the intelligence that they have. Okay, we can for some reason explain a menu with the most complicated spices and food items. How come everybody can figure out like what a pork belly is and what foie gras is and everything else? But for some reason we can't explain.
Really, I still can't figure out what sweetbreads are, but okay.
Sweetbreads.
Yeah.
But we still can't, for whatever reason, describe a vertical spread in the financial markets. I mean, you go to a restaurant with somebody that you don't really know, and they'll say, "I'll take this Sauvignon Blanc from blah 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 where in this particular year." So you're telling me you can remember a specific region and a specific year to order a Sauvignon Blanc, but you can't figure out what a vertical spread is in the financial markets, which may actually pay for this Sauvignon Blanc sometime in the future?
That's correct.
Okay, we rely on. We would never walk in and say, I shouldn't say never, but for the most part, you do not walk into a restaurant that you've never been before. And as you sit down, say, just bring me whatever you want. But we hand our money over to somebody and we say, just do whatever you want.
That's right. Sad.
Just bring me whatever you think is good. Okay. And just do whatever you want with my money. How crazy is that?
It is crazy.
I don't even know how I would do that. I can't even, I don't know how people do that. How do you walk in somewhere and you hand somebody your money and you say, do whatever you want. Just make me some money.
And usually those returns are...
But how hard is it just to sit down for a few minutes and say, hey, you know what? If I buy this one strike and I sell this other strike, and then you know what? I'm actually long Apple. And then if Apple goes higher, I can learn so much from that. And if Apple goes lower, I'm still going to learn so much from that. Because you know what I'm going to learn? I bought a $450 stock. The stock went down. I lost $125. I can live with that. Okay, I can live with that.
And I actually had a small cushion in a lot of cases where it was actually the spread I was buying gave me a cost basis that was lower than the stock is trading, and it was a bullish strategy, meaning I wanted the stock to go higher.
Which is more fun? You go to Vegas, okay, and you sit down and you play blackjack for 3 seconds and lose $1,000. In other words, you bet 333, 333, 333. The whole process together, because you're playing against the dealer, takes about 40 seconds. You get 3 hands in 40 seconds.
They deal very quickly.
They deal very quickly. So in 40 seconds, you lose $1,000. Is that fun?
No.
What if you take the $1,000 and you play all night long. You sit down at 6 o'clock, and at 6 in the morning, you're still there, and you have $900 left. Okay, is that fun?
Yes.
Okay, I agree.
Much better.
Much better. That's what this is. Except we don't even want to lose that $100.
Of course not.
Employ some form of a vertical mentality into your trading methodology, regardless of account size. If you have smaller accounts, you will employ it on a greater level. It's 8:27. We're back in
90 seconds with opening bell. You listen to Get Tasted on